And I'm Mira.
So imagine watching crude oil, specifically the U.S. benchmark West Texas Intermediate, just threaten $114 a barrel.
Right, hitting an intraday high near $113.97. It's wild.
Yeah, it's terrifying. And picture gold skyrocketing into the mid $4,600 range because of, this massive geopolitical conflict risk.
Exactly. I mean, by every traditional metric of market panic, stocks should be completely cratering right now.
They really should be. But instead, this past holiday-shortened trading week ending Thursday, April 2nd, the stock market posted a massive 3.4% rally.
Which just feels like it makes absolutely no sense.
It makes no sense at all. Well, not until you look under the hood of the market's fear gauge anyway. So welcome to this deep dive.
It is so great to be here because that contradiction you just outlined, it's exactly why we need to dig into the mechanisms of what is actually happening out there right now.
Yeah, we really do. And just to set the stage for you listening, it is Sunday evening, April 5th, 2026. Consider this deep dive your official Sunday night reset.
We definitely need a reset after this week.
Seriously, because we have this highly volatile mix right now. We're talking severe Middle East geopolitical risks, incredibly sticky structural inflation, and of course, the massive artificial intelligence capital expenditure supercycle.
All colliding at the exact same time.
Right. So to understand where we're going this week, we have to start by answering one massive question. So let's officially kick off Session 1.
Let's do it.
Session 1. How did markets finally snap their 6-week losing streak?
Right, because that 3.4% surge in the S&P 500, closing at 6,582.69, it really caught a lot of people off guard.
Oh, totally. I mean, the world feels like it's catching on fire, and stocks go up.
Yeah. But to understand why it happened, you have to look at something called equity risk premium, or ERP compression.
Okay, hold on. Let's unpack that term. Because equity risk premium sounds like something out of a graduate finance seminar.
It does sound super academic, yeah.
But it's actually driving the retirement accounts of everyone listening, right?
It absolutely is. So think of the equity risk premium as the extra compensation, like the extra yield that investors demand to hold risky assets.
Like stocks.
Exactly, stocks, instead of perfectly safe, risk-free government bonds.
Okay, that makes sense.
So back in March, when the conflict headlines really spiked and the Strait of Hormuz was facing blockades, systemic panic kind of set in.
Right, and the VIX spiked.
Exactly. The VIX, which is essentially the stock market's fear and volatility gauge, just surged.
Yeah.
And when volatility spikes, institutional computer models automatically expand that equity risk premium.
So they basically demand a higher return for taking on that risk.
You got it. And that raises the cost of capital, which violently pushes stock prices down.
So when fear goes up, prices automatically go down just to make the math work for the risk models?
Precisely.
Yeah.
But in the first week of April, we started hearing whispers of a geopolitical off-ramp.
Like a potential diplomatic solution.
Right. And because of those whispers, the VIX cooled incredibly fast. In fact, it dropped over 17% in a single day.
Wow, 17%.
Yeah, closing at 23.87 on April 2nd.
Okay, so the fear gauge plummets.
And when the fear gauge drops that rapidly, the equity risk premium compresses. The computer models see lower volatility, so they require less of a risk premium.
Which triggers a massive wave of mechanical buying.
Exactly, an automatic mechanical rally.
But wait, hold on. If the VIX dropping mechanically forces stocks up, aren't we just ignoring the fact that the actual physical risks are still very real? I mean, it feels like the market is walking blindfolded into a minefield just because the fear gauge blinked. I kind of look at it like a tightly wound rubber band.
That's a good way to put it.
Right. Did the underlying geopolitical and inflation risks actually disappear, or did the market simply stop pricing in an apocalyptic worst-case scenario?
The underlying risks are absolutely still there. It is entirely the rubber band effect. You have to remember that markets are probability machines.
Okay.
They aren't pricing in whether a situation is like good or bad. They're pricing in the probability of a specific outcome.
Got it. So they had priced in doomsday.
Right. A near certainty of an overnight catastrophic global energy supply wipeout.
Yeah.
When that probability dropped from, say, 95% to 60%, the algorithmic models just spot the difference.
So it was a mechanical relief rally driven by sentiment, shifting from catastrophic to merely highly concerning.
Exactly.
Well, that mechanical snapback is fascinating, but it rests on a massive assumption.
Which is?
That those underlying risks won't flare up again, and frankly, that relief might be incredibly fragile.
Extremely fragile.
So we're going to take a quick pause here, and when we return, we're diving into the weekend headlines to see exactly why that fragility is so dangerous.
See you in a minute.
All right, welcome back. Let's get right into session 2. What just happened over the weekend, and how does it collide with our current macro reality?
And there is a lot to cover.
There really is. If you listen to our last trading session recap, our Watch Next section was focused on 3 things.
Right. We were looking for kinetic U.S.-Iran conflict developments, the market reaction to Friday's unpriced jobs data, and any energy supply chain disruptions.
And we got massive developments on all 3 fronts. But quickly, before we detail the geopolitical events, we just want to offer a clear disclaimer to you listening.
Yes, this is important.
We are impartially reporting on the political and military actions from the source material just to assess the market impact. We are absolutely not endorsing any political viewpoints or taking sides here.
Exactly. We're just looking at the macro reality.
Right. So let's start with the economic data that the market hasn't even had a chance to digest yet, because U.S. equity markets were closed for the holiday.
Good Friday.
Yep. So on April 3rd at 8:30 a.m. Eastern Time, the U.S. added 178,000 jobs, dropping the unemployment rate down to 4.3%.
Which sounds great on paper.
It does. But I feel like every time we get a jobs report lately, the headline number is a complete mirage.
Oh, it absolutely masks the underlying weakness.
Yeah.
When you look under the hood of that 178,000 figure, it was heavily inflated by temporary anomalies.
Like what?
Well, first you had the reversal of severe weather effects that had artificially depressed previous counts.
Oh, sure.
And second, much more importantly, you had the return of striking workers.
This is the healthcare sector numbers, right?
Yes. The healthcare sector overall showed an addition of 76,000 jobs. But 31,000 of those were simply Kaiser Permanente workers returning to the payrolls after a strike.
Wait, really?
Yeah, so those aren't new economic jobs being created. That's just an accounting reconciliation of people going back to the jobs they already had.
Wow, that completely changes the context.
And it gets worse. The February numbers were quietly revised downward by a massive 133,000 jobs.
133,000.
Yep. So actual economic momentum is significantly weaker than 178,000 new jobs suggests.
But the bond market didn't completely melt down. Why is that?
Because of the wage data. Average hourly earnings cooled to a 0.2% month-over-month increase.
Okay, so wages are cooling.
Right. That continued wage deceleration is the only thing keeping bond yields from spiraling completely out of control.
But still, an unemployment rate sitting at 4.3% combined with that headline job growth, that's a problem for the Fed, isn't it?
A huge problem. It crushes any lingering near-term hopes for an interest rate cut. That's why the 10-year Treasury yield is still stubbornly above 4.3%.
So we have an environment where the Fed cannot cut rates to rescue the market because inflation is structurally stuck. And nothing guarantees inflation stays stuck, quite like a kinetic energy crisis. Which brings us to the weekend's escalation in the Middle East.
Right. And as we said, looking at this strictly through the lens of supply chains and risk premiums, targeting military and infrastructure assets fundamentally alters global capital flows.
Emotion doesn't price a barrel of crude oil.
No, it doesn't. Supply disruption probabilities do.
So let's track the chronological momentum of this escalation because the leverage between the actors shifted violently over the last 48 hours.
It really did.
It kicked off Friday afternoon, specifically April 3rd at 2:17 p.m. Eastern Time. A U.S. F-15E fighter jet was shot down over Iran.
And there was a lot of confusion at first. Early rumors on social media claimed it was an F-35.
Right, but visual analysis quickly confirmed it was an F-15E.
Which is significant. Losing a combat aircraft is a definitive kinetic escalation. It immediately forces a retaliatory response and drastically shrinks the window for diplomacy.
And the retaliation was incredibly swift. By early Saturday morning, April 4th, around 4 a.m. Eastern Time, U.S. and Israeli strikes hit the Mashhar petrochemical zone in Iran.
This is a crucial detail for the commodity markets. Hitting the Mashhar zone is not just hitting an empty runway.
Right.
That area is a massive hub for refined products and chemical feedstocks. It's the economic and energy base.
So when you target petrochemical facilities, you are directly threatening the structural supply of global energy.
That is exactly why West Texas Intermediate crude is fighting to break $114 a barrel. The market is pricing in the destruction of actual physical energy infrastructure.
Now, we did see one moment of tactical de-risking. Late Saturday night, April 4th at 10 p.m. Eastern Time, the U.S. military successfully rescued the downed F-15E Aviator.
Which is huge. Taking a hostage situation off the table removes a highly unpredictable emotional and political trigger.
Right. Recovering the Aviator means policymakers aren't forced into hasty rescue-driven escalations.
Exactly.
Yeah.
But while it solved a tactical crisis, it definitely didn't resolve the broader strategic standoff over the Strait of Hormuz.
Not at all, because earlier that evening at 8:02 p.m. Eastern Time, President Trump issued a strict 48-hour ultimatum to Iran to reopen the Strait of Hormuz.
And then the rhetoric escalated again?
Yeah, on Sunday afternoon, April 5th at 2:20 p.m. Eastern Time, we saw explicit threats to strike Iranian power plants and bridges if that deadline wasn't met.
Explicitly naming critical civilian and state infrastructure, like power plants and bridges, it imposes a very tight binary policy horizon. Meaning a 48-hour deadline tells the market it doesn't have time to wait and see. You're either getting near-term compliance or you're getting an explosive military escalation that could completely disrupt Gulf energy flows.
But here's where the whiplash comes in. While the threat of missiles hitting power plants is dominating the headlines, we're simultaneously seeing a sliver of diplomatic hope.
Right, the back-channel diplomacy.
Yeah. Oman reported transit talks with Iran at 5 a.m. Eastern Time on Sunday. And then President Trump actually went on Fox News at 9:58 a.m. Eastern Time and hinted that a potential deal might be reached by Monday.
Oman historically acts as the neutral broker in the Gulf. The fact that talks are happening there proves that a diplomatic off-ramp isn't just theoretical, it's possible.
This is the definition of market whiplash.
It really is. You have algorithmic trading models trying to digest back-channel Omani diplomacy right alongside 48-hour ultimatums for infrastructure bombing.
I call this the commodity transmission mechanism.
No.
The market isn't just trading geopolitical news for the fun of it. When you threaten power plants, that threat bleeds directly into the price of crude oil.
Exactly.
And when crude sits at $114, that bleeds directly into the inflation fears we just talked about from the jobs report.
They are part of the exact same inflation loop. The market is caught in a violent tug of war between sticky inflation, keeping the Fed's rates elevated, and a geopolitical powder keg dictating the base cost of energy hour by hour.
It's intense. Let's take one more quick verbal break. When we come back, we'll look ahead to the coming week.
Sounds good.
All right, we are back for session 3. What exactly are we watching as the Monday bell rings?
Well, the calendar is packed with immediate policy triggers, and they are going to test this fragile market rally right out of the gate.
Let's start with Monday, April 6th. The expanded Section 232 metal tariffs take effect.
Right, these were just signed on April 2nd at 12 p.m. Eastern Time.
Exactly, and we're talking about 50% duties on certain metal-intensive articles.
Which is a massive structural shift. It significantly broadens the trade policy overhang.
And how does that complicate things for, say, import-dependent sectors?
Mechanically, it's brutal. If you're an import-dependent manufacturer, your input costs just skyrocketed overnight. You can't just absorb a 50% duty.
So they pass it to the consumer.
Exactly. It's an immediate government-mandated inflationary pressure point hitting exactly when we desperately need inflation to cool down.
Yikes. And then we circle Tuesday, April 7th, the expiration of that 48-hour ultimatum. The market is basically calling it power plant and bridge day.
Right. We could see massive gap risks in oil and gold, depending on whether Tuesday brings a signed Omani transit protocol or military strikes.
And then Wednesday, April 8th, we get the FOMC meeting minutes release,
which will show us exactly how much the Fed is panicking about this stagflationary pressure.
But the real collision happens when we look toward mid-April.
The corporate earnings cycle.
Yes, the Q1 2026 earnings cycle kicks off with the major banks, And here's where I think the market relies on what I'd call brute force earnings expansion.
I like that phrase.
Think about it. Imagine trying to run a marathon while wearing a 50-pound weighted vest. That vest is the 4.3% risk-free treasury yield.
Right, because higher risk-free rates compress valuation multiples.
Exactly. The days of buying a software company based purely on a promise of growth in 2030 are dead. The market's floor relies entirely on companies proving they can generate massive, resilient physical cash flows today. They have to brute force it.
And that ties perfectly into the underlying market rotation we're seeing. Capital is aggressively flowing into industrials, energy, and consumer defensives.
Right.
But the absolute biggest driver of this brute force requirement is the artificial intelligence supercycle.
The staggering $690 billion AI infrastructure sprint.
It is massive. This is no longer a software race. It's a physical battle. Amazon is pouring $200 billion mostly into physical AWS data centers. Alphabet is committing $185 billion.
And Microsoft?
Microsoft has an $80 billion backlog in Azure orders.
$80 billion in backlog alone.
Yes, and it's not a lack of demand. It's entirely due to severe power constraints.
They
physically cannot secure the electricity and land fast enough.
No,
They even just announced a $10 billion AI infrastructure investment in Japan to try and diversify their grid reliance.
So it's a battle for land, power, data centers, and raw materials, like germanium.
Exactly. Germanium is a vital fiber optic material, and prices are surging right now. Right. It's arguably the largest coordinated capital deployment in human history.
It was just wild. So before we sign off, I think we need a Sunday night reset joke just to capture the sheer absurdity of this market.
Oh, please.
So welcome to Sunday night, where investors are desperately trying to guess if Monday's opening bell brings a Middle East peace deal, a military strike on Iranian bridges, or just more expensive aluminum.
Right.
We finally snapped a 6-week losing streak and got our downed pilot back, only to realize we still have to trade a Good Friday jobs report while a 48-hour geopolitical doomsday clock ticks down in the background.
It's exhausting.
Pour yourself a stiff drink and try to get some rest, because tomorrow's market forecast calls for a 100% chance of whiplash.
A 100% chance indeed. But before we go, I do want to leave you with one final unexplored thread to mull over.
What's that?
Well, if the AI supercycle demands unprecedented, almost limitless physical energy to power its $690 billion data center build-out,
yeah,
what happens to that technological revolution if the geopolitical choke points of old-world energy like the Strait of Hormuz are permanently sealed off? Yeah. Can the AI sprint actually survive a sustained global energy drought?
Man, that is the ultimate question hanging over the market right now. Thank you all for joining us for this deep dive, and please let us know your thoughts and predictions down in the comments.